Well, 2025 was a wild ride for the global markets, and believe me, the final month was no different. It really capped off a super eventful year. So, what actually went down in December? Okay, let's dive right in and break down what it all means as we head into a new year. If you could capture the global economy in 2025 in just one picture, this would probably be it. Just think about a year filled with these unpredictable storms and sudden crosswinds. That's exactly the kind of choppy water investors were dealing with, just trying to keep the ship steady and pointed in the right direction. So, what were those storms, really? What were the huge economic currents pushing and pulling on everything as we finally close the book on the year? Let's start with that big, wide angle view before we zoom in on the details. Okay, let's kick things off with the global headwinds. This was the fundamental backdrop, right? The stage on which all the market drama of December was about to play out. And man, the challenges were not small. We're talking about geopolitical tensions flaring up, creating all kinds of volatility. There was a very clear slowdown in hiring and wage growth pretty much everywhere, and governments were all feeling the squeeze on their budgets. And on top of all that, while U.S. inflation was cooling down to 2.7%, which is good news, China's massive economic engine was slowing to 4.8% growth. And that's a huge shift for the entire world economy. So, faced with this really complex picture, the world's big central banks, they went in completely different directions. I mean, just look at this split. The US Fed decided, okay, time to cut rates, signaling their whole tightening cycle might be over. The European Central Bank, on the other hand, just held firm, basically playing a waiting game. And then you have the Bank of Japan, which did the exact opposite and hiked its policy rate to a level we haven't seen since 1995. So you've got three major powers, three totally different playbooks. But here's the thing. While the rest of the world was zigging and zagging, one major economy was just forging its own path straight ahead. So now, let's turn our attention to India, which really proved to be this incredibly resilient outlier in the middle of a global storm. And the contrast is it's stark. While the rest of the world was wrestling with slowing growth and all these different pressures, India's story was all about becoming the fastest growing major economy on the planet. And how did they do it? Well, it was powered by two incredibly strong engines: domestic consumers who just did not stop spending, and a massive push in public investment that just kept building more and more momentum. And if you need just one number to really get the scale of this story, this is it: 8.8%. That was India's real GDP growth for the first half of the fiscal year. I mean, a figure like that doesn't just stand out. It puts India in a totally different league from the rest of the pack. But here's the truly remarkable part. This incredible growth wasn't causing prices to spiral out of control. Inflation was actually super low at just 0.71% in November. So you have to get this. India had both high growth and low inflation. That is the absolute economic sweet spot. It's the dream scenario, really. Okay, so we've got this incredible economic story. But what did that actually mean for investors? How did this powerful macro picture translate to the stock market? Well, that's where things get a little more complicated. Because what was happening inside the Indian market was this fascinating tug-of-war playing out in real time. You had two giant groups of investors looking at the exact same economy, the exact same data, and coming to completely different conclusions about what to do. This chart right here tells the whole story. In one corner, you've got the domestic institutional investors. We're talking Indian mutual funds, insurance companies, and they were incredibly bullish, pouring in almost 80,000 crore rupees. But in the other corner, you have the foreign institutional investors, pulling out over 22,000 crores. A total split in opinion. So what was making the foreign investors so cautious? Well, this quote really gets to the heart of it. After a period of huge excitement and a massive run-up, the market just wasn't seen as a bargain anymore. The mood was shifting, away from that euphoric feeling down to something a lot more neutral, a lot more cautious. And you can see that cool down right here in the data. The price-to-earnings ratio, which is basically a key measure of how expensive the market is, fell to 25. Now, what's so important about that number is that it's actually almost 2% below its 10-year average. So what that suggests is that for people looking past the short-term mood, valuations were actually starting to look a whole lot more attractive. Now, if the stock market story was a tug-of-war, the bond market was a complete puzzle. Let's switch gears to fixed income, because something happened in December that seemed to just defy all economic logic. So here's the question that had traders scratching their heads. The Reserve Bank of India cut interest rates. Now, Basic Economics 101 says that when rates go down, bond yields should go down too. But that's not what happened. The exact opposite happened. So what on earth was going on? Let's just break this down. First, the RBI cuts its key policy rate. Standard stuff. But, and this is the key part, the market was actually disappointed. They were maybe expecting a bigger cut. And that disappointment caused a sell-off, which weirdly pushed the 10-year bond yield up to 6.7%. So, seeing this reaction, the RBI had to step back into the ring, announcing major bond purchases to calm everyone's nerves and get things stable again. Just a total roller coaster. So, after all that action, the global slowdown, India's resilience, the tug-of-war in stocks, and that puzzle in the bond market, where did the dust finally settle? Let's check out the final scorecard for December. Here it is, a quick snapshot. The BSE Sensex, after all that buying and selling, end of the month pretty much flat, down just a tiny fraction. The 10-year government bond yield, after its wild ride, settled at 6.58%. The rupee held strong at 89.9 to the dollar, and Brent crude oil was trading at a relatively calm $60.9 a barrel, a surprisingly stable finish to a pretty volatile month. And it's really worth pausing on the Indian rupee for a second. With all the global volatility and all that foreign money flowing out, you'd think the currency would be under a lot of pressure, but it held its ground. And that's a testament to two things: active management by the RBI and, circling all the way back to our main theme, the sheer strength of India's underlying economic fundamentals. So we end December 2025 with a really clear picture: a challenging global environment, but a super resilient Indian economy and a domestic stock market with valuations that have become much more reasonable. And all of that leaves us with a key question to think about as we look ahead. With this unique setup, what kind of opportunities will 2026 bring?